Bismillahirrahmanirrahim. Assalamu alaikum to everyone. Those they are watching this video lecture. I'm Sir Abeel Ahmed from Abeel School of Accountancy. I'm going to discuss, inshallah, question 4 of the last attempt of P6 right now. Let us read first requirements, then inshallah we'll be discussing uh, how to solve these requirements. That would be more important and more interesting. Let's read first requirements. Question 4, part A1. Calculate taxable trading profit of MT travel for each of the tax years 16, 17 and 17, 18. We are just supposed to calculate, we are just required to calculate taxable trading profit of MT travel for each of the tax years 16, 17 and 17, 18 before considering relief for anticipated trading losses for the tax year 18, 19. We just need to calculate taxable trading profits for 16, 17 and 17. 18, we are not going to consider what are the law anticipated, what are the reliefs available for anticipated trading losses for the tax year 18, 19. 3 marks. Next requirement says identify and explain one practical disadvantage of MT travel having a 31st March year end rather than 31st December year end. Simply what happens if your year end is 31st March, you will be having less time to pay tax, you will be having less time for tax plannings, all sort of stuff will come into the business, we'll be discussing that. Requirement B1, calculate allowable trading losses available to each of Meg and Laurie for the tax year 18-19. If Laurie becomes an employee or alternatively a partner in MT Travel on 1st April 18. We need to calculate allowable trading loss. B1, we just need to calculate allowable trading loss available to each of Meg and Laurie for the tax year 1890. Laurie becomes an employee or alternatively a partner. Okay. Next, see what happens. Point 2. We will be reading the data and then we'll come to know what sort of discussion is this, because this will be very interesting. What sort of losses for employees? Let's read the requirement more. B. Requirement 2. Advise Meg and Laurie of the alternative ways in which their respective trading losses as calculated in B1 could be used depending on whether Laurie is taking it on as an employee or as a partner. State the rate at which income tax would be saved in each case. As far as tax saving is concerned, it depends on individual's paying position. If the individual is a basic rate taxpayer, he or she is going to save 20% tax. In case of higher rate taxpayer, they will be saving 40%, and additional rate taxpayers, if they are additional rate taxpayer, they will be saving 45%. Let's read next requirement. C. Explain the VAT effect of MT Travel purchasing services from overseas suppliers rather than UK suppliers. If we buy services from overseas suppliers, then what sort of rule will come into the business? That's a business to business transaction. We'll be discussing that as well, inshallah, later on. Let's read the question now, what it says. That was all about the requirements. Just a minute, just a minute, just a minute. Comes here. Before solving any question, you are supposed to read the requirements and then let's jump on a question. Meg is an unincorporated sole trader. She requires advice regarding a planned change of accounting date. Stop over here. She requires advice regarding a planned change of accounting date. It means the first topic which must come in your mind is change of accounting date. As far as change of accounting date is concerned, there are 4 rules, and I strongly believe that everybody knows what are the 4 rules of dealing with change of accounting date. Bringing her husband into business either as an employee or as a partner. Now stop over here. Now partnership business should come in your partnership topic must come in your mind when it says bringing her husband as a partner. Either she's going to bring her husband as an employee or as a partner. Let us discuss here over here a very important point is if she brings her husband as a partner or as an employee, then everybody knows that if her husband works as an employee, then salary to an employee is an allowable expense. Salary to an employee is an allowable expense. But as far as partner is concerned, if her husband comes into the business as a partner, then salary to partner is not a deductible expense. Husband is an employee, salary is deductible expense. Husband as a partner, salary is not a deductible expense. In fact, husband is an employee. Whatever benefit you are going to provide to your husband, all those benefits will be treated as deductible expenses. And on all those benefits, business will have to pay NIC as well. Either class 1 employer or class 1A employer. Then business will have to pay NIC as well. Let's move further. And value added tax VAT implication of purchasing from an overseas suppliers. If you buy something from overseas suppliers, so what sort of discussion we will be discussing, then VAT topic should come in your mind. So topic identification, change in accounting date is one topic, another is partnership, and third is VAT. The good thing about P6 is in one single question you will not be testing only each question will not be testing a single topic. Our examiner basically our examiner or even examination team, what do they do? Basically in the same question they will be asking number of topics. The same thing you can see over here. Change of accounting date is 1, so far partnership 2, VAT 3. Let's go ahead. Mag is 60 years old and married to Laurie, owns an unincorporated sole trader business, MD Travel. Has rental income 8600 each year in addition to any profit from MD Travel. Has rental income of 8600 each year in addition to any. Right now we don't know what amount of profit Mag is going to get from MD Travel, but without having the information of that profit, clearly we can see the income which is just 8600, and 8600 income is even lower than personal allowance. If there is no profit is coming, just an example, for example, if there is no profit which is coming from MD Travel, then Meg is not paying any tax, because whatever the income, rental income is, it is lower than personal allowance. Now let's read what it says. MD Travel was set up by Meg on 1st January 2012, has had accounts prepared to 31st December annually. Generates overlap profit 7400 on commencement. Let's stop over here. Whenever a business starts, then basis period comes into the business. What did I say? Did you hear me? When we start the business, then basis period will come into the business. And when you start your business from 1st January and your year end is 31st December, then your overlapping profit will be of 3 months. Let me repeat. If you start your business from 1st January and you decide that your year end is 31st December, then your overlapping profit will be of 3 months. The question arises, why our examiner has given us overlapping profit? The answer to this question is, you can see the first line in which change of accounting date was given. The topic change in accounting date does require overlapping profit, in which rule may be the rule 1, 2, 3, 4, but we'll see that. It has a link with that change of accounting date. Meg will change its accounting date to 31st March by preparing accounts for 15 months ending 31st March 2000 ending 31st March 2018. She is going to change accounting date from 31st December to 31st March, and she is going to prepare accounts for 15 months. If she is going to prepare accounts for 15 months, then what happens? From that 15 months profit, we'll be deducting that overlapping profit of 3 months so that we can make it the profit of 12 months. So they have exactly given us 3 months profit. Let's read further what it says. Empty travel recent and forecast adjusted trading profit. Year ended 31st December 16 is 17,000. This will come in 1617. And 15 months ending March 18 profit, it comes in 1718. But this is of 15 months and change of accounting date is over here. We all just need to do is one simple step we have to perform. What we'll be doing? From that 15 months profit, we'll be deducting 3 months overlapping profit so that we can make that profit for 12 months. Let's read further what it says. Empty travel the future. From 1st April 2018, Meg's husband Laurie will start to participate in the business. Employ Laurie part-time paying an annual salary of 12,000, the commercial rate for the work he will perform to. If Laurie works as an employee, then 12,000 salary will be deductible. If Laurie works as a partner, then that 12,000 is not deductible. Admit Laurie into the business as a partner, sharing profit and losses in the ratio 75% to Meg and 25% to Laurie. Okay, the business is expected to generate a tax-adjusted trading loss in the tax year 18-19 of 20,000 before making any payment to Laurie. The business is expected to generate tax-adjusted trading loss. Stop over here. Whenever a new partner comes into the partnership or XYZ person joins the business as a partner, from that date, business starts for that new partner. Repeat. Whenever a new partner joins the partnership firm, from that joining date, a new business actually he or she is starting. It means when her husband comes as a partner to empty travel, then it means that the new business will be started for her husband. And when an individual starts the business, then there are many loss reliefs available. Some of the loss reliefs available, we say they are special loss reliefs available for opening year losses. We'll discuss that as well, inshallah. The business is expected to become profitable again in the tax year 1920 and thereafter, but profits are not expected to exceed 30,000. Okay, let's move further. Laurie is 63 years old, was employed for many years by Hug Limited, earning gross annual remuneration of 60,000 until 31st March 17. Has received annual dividend of 18,000 for many years. This is currently his only source of taxable income. Is 63 years old, was employed for many years. Gross earnings 60,000 means Laurie is a higher taxpayer. And right now still he is receiving 18,000 annual dividend. As far as dividend is concerned, I believe everybody knows that the first 5,000 will fall in nil rate band, irrespective of which taxpayer are you. Either you are paying basic rate taxpayer, or either you are a basic rate taxpayer or higher rate taxpayer or additional rate taxpayer. It makes no difference. First 5,000 of dividend income is will fall in nil rate band. Now let's discuss what it says. Empty travel. Empty travel is registered for the purpose of VAT. Empty travel currently buys standard rated marketing services from a UK supplier who's VAT registered, okay, empty travel can buy the same services from supplier located in an overseas country which is not in EU with the rate of the VAT is 12%. This we'll be discussing this for last requirement, I believe, VAT, that when business to business transaction occurs and when we buy services from another business which is even not in UK, that is in overseas country which is not in the EU as well. So we'll see that what sort of rule will apply. Basically, the rule will be very simple. Simply, whatever VAT you have paid in overseas, that is not relevant in UK. Number one. Number two will be you will be paying standard rate input VAT in UK, but that input tax will be recovered. Whatever appropriate VAT return return times will come, you will be claiming that input which you have paid in UK. It is sort of something like that we'll be discussing later on. Now, how to approach and how to solve this question, I will be discussing on the whiteboard so that we can be looking at each and everything clearly. Thank you very much.
Now let us discuss the answer of that question 4. Point number 1 first. In point number 1, we have to just discuss taxable trading profit of empty travel for each tax year 16, 17 and 17, 18. In tax year 16, 17, we have been given straightforward taxable trading profit of 17,000, which is straightforward, there is no need to do anything. When it comes to 17, 18, basically in 17, 18, what has happened? Empty travel has changed their accounting date. Due to that change in accounting date, the new accounting period is of 15 months. If the new accounting period is more than 12 months, I have to make it 12 months period. How to make it 12 months? All we have to do is just one thing, that is, we are supposed to deduct overlapping profit of 3 months, which is given in the question. So out of that 15 months, I am deducting 3 months overlapping profit, which is given in the question. We will be having the taxable trading profit for 17, 18, 1600. It means that empty travel in 17, 18 is not going to pay tax on 9,000. Actually, empty travel is going to pay tax on 1600 in 17, 18. As far as question 4 part 2 is concerned, in which they have asked, just discuss one practical disadvantage of changing the accounting date from December to 31st March. If empty travel changes their accounting end from December to 31st March, then one practical disadvantage will be they will be actually having less time for tax planning and tax payments. I believe that is good enough for 2 marks. Over here I have written my answer. In case of year end 31st March instead of 31st December, empty travel will be having less time for tax planning and tax payment. This is all about question 4.1 and 2. Later on I will be discussing next part of the same question as well, inshallah. Let us now discuss question 4 B requirement 1. That is, we need to calculate allowable trading losses available to each MIG and lorry for the tax year 18-19. A very important point is, when lorry joins empty travel as an employee, then we know that salary given to lorry will be treated as a deductible expense. Not only the salary which is given to lorry will be treated as a deductible expense, in addition to that, employers class 1 NIC will be treated as a deductible expense which will be paid by empty travel because of the salary of lorry. Second, any taxable benefits which are given to lorry by empty travel will also be treated as deductible expense. Only those benefits which are deductible. This is the portion when lorry joins as an employee. I hope it is readable. This is when Lori as a partner. You can see the answer. This is PSR is 75:25. Profit sharing ratio, but over here is the same ratio will be applied on the loss. I hope it will help you. Let me discuss question 4 of the last attempt which has uploaded. It's requirement question 4B. That is advise Meg and Lori of the alternative ways in which their respective trading losses as calculated in B1 could be used depending on whether Lori is taken as an employee or as a partner, or state the rate at which income tax would be saved in each case. Let us first discuss loss relief to the wife of Lori, which is Meg, Meg. What are options which are available to her? A very important point is when Lori is treated as an employee, then in that case tax allowable loss is 32,000. And when Lori will be treated as a partner, then tax adjusted trading loss is 15,000. Either the loss is 32,000 or 15,000. What are the options available to wife of the Lori, that is Meg? Option 1 which is available to her is she can deduct the loss against total income of 18-19, or even she can go 1 year back 17-18. It's up to her, either first 17-18 and then 18-19, or 18-19 and then 17-18. But before using the entire loss against total income of 18-19, or that is 17-18, she needs to consider what are the objectives of using tax adjusted trading losses. A number of objectives, out of those number of objectives I'll be mentioning and discussing at least 2 over here. One is before utilizing the losses, she needs to consider the fact that she should try to save personal allowance if possible. If it is not possible, of course nobody can help it, but if you can save your personal allowance, then try to save the personal allowance. Objective 2 is try to use your losses as soon as possible. The question arises, if we will be using our losses as soon as possible, what benefit she is going to get? Actually, if you will be using your losses as soon as possible, you will be saving yourself from not facing the loss of time value of money lost. To try to save your personal allowance if possible. Another objective is try to use your losses as soon as possible. But as far as the scenario in this question is concerned, the wife of the Lori, Meg, is having total income of 8,600 in 18-19. 8,600 income means the entire income is covered under personal allowance. If we are going to deduct any loss from the total income of 18-19, in that case actually we will be not saving any tax. The question is, she will not be saving any tax. Why? The answer is her total income is covered in personal allowance. It means actually she is not paying any tax. If you are not paying any tax, it means you are not saving any tax. So she is not actually paying any tax, so there is no benefit of deducting the loss from 18-19. Now let's talk about if we can go for 1 year carryback, that is 17-18. In case of 17-18, her total income is 10,200. The question arises, how did I get this 10,200? Actually 8,600 is over there plus 1,600. The question is from where we are getting this 1,600. The answer is very simple. 1,600 basically the same question for a requirement A1 in which we have computed tax adjusted trading profits. From there I am getting that 1,600 when accounting date was changed, and I will explain you. From there I will be getting 1,600. So 8,600 plus 1,600 comes to 10,200. It means in 17-18 the entire total income is again covered in personal allowance. So it means that if we go 1 year carryback, if she goes 1 year carryback and deduct the loss from the total income, she will not be saving any tax. That's why over here we will be advising her to carry forward the loss. When she is going to carry forward the loss, in that case she is going to save the tax of 20%. Her tax rate saving rate will be 20%. Question arises, why tax rate which she is going to save will be 20%? The answer is very simple. You can see in the question, The future expected loss is 30,000. The future expected loss, which is 30,000, is not. It means she is not going to exceed basic rate tax band. Number one. Number two is the entire 30,000 comes in non-saving income. The entire 30,000 comes in non-saving income. The tax rate is 20%. Basic rate band is not exceeding. So simply the tax rate saving will be 20%. Now let us discuss tax adjusted losses relief for lorry. Mr. Lorry, if we discuss for Mr. Lorry, the question arises if Mr. Lorry joins MT Travel as an employee, then what happens? And if Mr. Lorry joins MT Travel as a partner, then what happens? A very important point is when Mr. Lorry joins MT Travel as an employee, then there's no loss issue arises. How it is possible? It's not possible at all. When you join a company and your company is facing loss, it does not fall on you. It does not belong to you. Don't worry. You'll be getting your salary. As far as Lorry, if he joins MT Travel as an employee, then no loss relief issue will arise for Lorry. But when it comes to joining MT Travel as a partner, then of course Lorry is going to get the loss share of his loss, and he is going to get the loss relief as well. The loss which we have already computed is amount of 5,000. The question is, what are the options which are available to Lorry? Let me discuss. Option 1 is total income of 18-19. Another option is 1 year carryback 17-18. But in case of 18-19 and 17-18, in both the years, the entire income of Lorry is coming from the dividend income. If entire income is coming from the dividend income and which is falling under the basic rate band, it means Mr. Lorry is going to just save 7.5%. If Mr. Lorry is just going to save 7.5%, so why not to think better than that? Better than that, another option is available. What is that? Better than that, another option is available. Actually, when you join a partnership firm as a partner, what happens? At that point, we say you are starting an unincorporated business. Repeat. When you join a partnership firm as a partner, we say from that point you are starting an unincorporated business. When you are starting an unincorporated business, then HMRC gives you special opening year loss relief. In that special opening year loss relief, what happens? If you face any losses in the first 4 tax year of your business, if you have any loss in the first 4 tax years of your business, then you can carry back that loss for 3 years. And you can carry back the loss for 3 years and set off against total income on FIFO basis. Over here, we'll be advising Mr. Lorry to carry back the loss for 3 years and set off against total income. In that case, Mr. Lorry is going to save maximum tax rate of 40%. Now the question arises, how Mr. Lorry is going to save tax rate of 40%? The answer is, till 31st March 2017, he was generating total employment income of, gross total employment income of 60,000. 60,000 means he was a higher taxpayer. In that case, we can say he will be saving 40% tax rate. So it is advisable to Mr. Lorry to carry back for 3 years, set off against total income on FIFO basis. In that case, he is going to save tax rate of 40%. Later on, I'll show you my answer, which I've already written for you on the whiteboard. What is that answer? How to formulate the answer? This was all about question 4, part B, point 2. You can see this answer. I believe it is readable. Loss relief for Lorry. If he joins MT Travel as an employee, no loss relief issue arises. All that stuff. Still, if it is not readable or you have an issue, you can ask me on FB. Otherwise, I'll do one thing. I'll type this answer and upload on my Facebook. Thank you very much. Let us now discuss this questions, question 4, requirement C, which is the last requirement. Simply it says, explain the VAT effect of MT Travel purchasing services from the overseas suppliers rather than UK suppliers. Simply, if a business purchases services from an overseas supplier, that's a business to business transaction. In that case, what happens? Reverse procedure charge will be applied. In reverse procedure charge, what happens? A business which is in UK, in that case an MT travel business, which is receiving services from overseas suppliers, MT travel will have to pay output tax at standard rate on its VAT return to UK authorities, and then same output will be claimed as input tax. So let me repeat what it is actually. Normally what happens, first we give input tax and then we charge output tax, then we charge output tax to our customers. Over here what is happening in reverse procedure charge, MT travel will pay actually output VAT to HMRC, and then same output VAT will be treated as input. Overall we can say it will have no effect on MT travel, but that's a reverse procedure charge, first output then input. Another question arises that what about that VAT which we have paid in overseas? Actually whatever VAT MT travel has paid in overseas, that is not relevant at all. So simply in reverse procedure charge you will be paying output VAT to HMRC, and then same output will be treated as input. And let me show you my answer on this part which I have written for you. Wait for a minute. That's the answer for question 4, part C. Receive services from an overseas business is B2B, business to business. So place of supply is UK. A reverse procedure charge will be applied. MT travel UK business accounts for output VAT at a standard UK rate on VAT returns. This VAT can be claimed as input VAT. Overseas VAT is not relevant. And this is all about question 4 of the last attempt.